Welcome, everyone. Today, we are going to tackle a concept that, look, a lot of people just see as a number on a balance sheet, but it's actually one of the most critical indicators of a company's health and its future plans. And that's retained earnings. It's so often misunderstood, you know? People think it's just this simple corporate piggy bank. But the reality? Oh, the reality is so much more complicated. It's more like a battleground of competing interests. You've got shareholders who want their payouts, you've got lenders who are demanding stability, and then you have management who desperately needs capital to grow the business. The rules that govern this single number are complex, and they are legally binding. So mastering them isn't just about accounting. It's about understanding this fundamental tug-of-war that really defines corporate strategy. This is a core skill for any of you who want to be a business leader. So let's put you right in the hot seat. Imagine this scenario. It's your first big board meeting. You're the new analyst. The CEO turns, looks you right in the eye, and asks this exact question on the slide. We've got $50 million in retained earnings. Tell me, can we pay it all out to our shareholders? And the room just goes quiet. Everyone's looking at you. Your answer in this moment is going to define your reputation. See, this isn't just a numbers question. It's a real test of your financial acumen. So what do you say? Don't worry, by the end of our time together today, you are going to have the framework to answer this with complete confidence and probably impress that entire boardroom. All right, to crack this problem, we have to start with the forces outside the company. You see, a corporation, it's not an island, right? It's part of a bigger ecosystem with rules that are not optional. These are the hard constraints, and they're imposed by two really powerful players: governments and creditors. This is what we call the external rulebook. And when it comes to this rulebook, believe me, there is no negotiation. It's all about compliance, pure and simple. Now, the formal term for these rules is retained earnings restrictions. And as the definition here says, these are legal or contractual limits on how much you can actually pay out in dividends. The whole savings account analogy, it's a good start, but let's take it a step further. I want you to imagine it's more like a trust fund, okay? The total amount in the fund might be huge, but the rules of the trust, the fine print, dictate exactly how much can be withdrawn and for what purpose. And why? Well, it's to protect the long-term health of the whole entity. The balance sheet number, that's just the headline, but the restrictions, that's the fine print. And in finance, the fine print is everything. Okay, so this slide breaks down the two main sources of these external rules. First up, we've got the government. You can think of this as a solvency buffer. Historically, this actually comes from this old concept of legal capital, which was to make sure a company always kept at least the par value of its stock as a cushion. Nowadays, lawmakers impose these restrictions to protect the entire economy. I mean, they want to prevent a situation where a company pays out these massive dividends and then the very next day can't pay its employees or its suppliers. That would cause a huge ripple effect. So this is really about systemic stability. Then on the other hand, you've got contractual restrictions. These are much more personal. This is the bank, the lender, protecting its own skin, its own investment. When a bank loans a company millions of dollars, they write something called a debt covenant right into the contract. And this is a legally binding promise that the company will follow certain rules, like maybe maintaining a specific current ratio, or really crucial for our topic, limiting how much it can pay in dividends. This just ensures the company doesn't go and recklessly pay out a bunch of cash that really should be set aside for loan repayments. So you've got two different motivations here. One is public, one is private. You've got the law of the land and the law of the deal. And both of them are equally binding. So that's the external rulebook. But the story, of course, doesn't end there. Now we need to look inside the company. What about the rules that the board of directors creates for itself? This is where our analysis really shifts from just compliance with outside forces to proactive internal strategy. This is all about using retained earnings, not just as some buffer, but as a strategic weapon for future growth. And this slide really gets to the heart of the why. These internal rules, which we formally call voluntary reserves or appropriations of retained earnings, are basically a public declaration of the company's game plan. So when a board earmarks funds for, say, a future plant expansion, what they're really telling the market is, hey, we're betting on future growth, and we're forecasting demand that's going to exceed what we can currently produce. When they set aside money for R&D, they're signaling a deep commitment to innovation, which is absolutely critical for valuation in sectors like tech or pharma. Setting up a reserve for a potential acquisition, well, that screams a growth strategy. And a cushion for an economic downturn, that sends a message of stability and prudence to investors. So you see, each one of these isn't really a restriction in a negative sense. It's the board using the balance sheet to communicate its roadmap for creating future value. It's financial storytelling at its best. Okay, so we've dissected the external rulebook. We've looked at the internal game plan. We have all the puzzle pieces we need. Now, it's time to put it all together. Let's step back into that boardroom, put on our CFO hat, and let's make the financial call. We're about to calculate the true amount that's actually available for dividends. And here it is, the moment of truth, laid out right in this table. We start with that big, shiny headline number, $50 million. Looks fantastic on paper, right? But now we apply our framework. First, we have to deduct the $5 million required by law for capital maintenance. That's non-negotiable. Gone. Then, we subtract the $15 million that our debt covenant with the bank demands. That's a contractual obligation, and we have to honor it to avoid defaulting on our loan. And finally, we account for the $10 million our own board has formally appropriated for that crucial R&D project. We subtract that too. And as you can see, each layer of these restrictions just takes a slice of the pie. And just like that, our $50 million mountain of retained earnings has been carved down to a $20 million hill of truly distributable cash. So let's go back to that boardroom. The CEO is looking at you. Your answer? It's a firm, it's a confident, and it's an analytically sound no, we cannot. But you don't just say no, right? You explain why. You walk them through the exact calculation we just did, showing them that after all the legal, the contractual, and the strategic obligations are met, the true amount available for distribution is only $20 million. This is the moment you prove your value. You've gone way beyond just reading a number off a page, and you've delivered a genuine financial analysis. Now, understanding this is absolutely crucial. And why is that? It's because just taking that big number from the balance sheet at face value is maybe the single biggest rookie mistake in all of financial analysis. I see it all the time. It is a trap, and it leads to flawed company valuations, incorrect credit analysis, and just plain bad strategic advice. So to make sure you avoid these pitfalls, let's nail this down into a simple, repeatable framework you can use every single time. Here it is. Your 3-step framework. I want you to memorize this. First, step 1, look beyond the headline number. That retained earnings figure is your starting point, not your conclusion. Second, step 2, read the notes. I cannot stress this enough. The footnotes to the financial statements are not optional reading. They're an integral part of the statements where the company legally has to disclose these restrictions. All those juicy details about debt covenants and appropriations, they're buried in there. Finally, step 3. You have to ask why. When you see those voluntary reserves, put on your strategist hat. Ask yourself, why did the board make this choice? What does this appropriation tell me about their vision for the future of this company? This is how you move from simple accounting to true analysis. So I'll leave you with this final question to think about. Now that you know the rules, now that you understand that retained earnings isn't some static pool of cash, but a dynamic field of play that's shaped by laws and contracts and strategy, how does this permanently change the way you analyze a company? It should force you to look past the historical numbers and to see a living, breathing organization that's making critical choices about its future, right now. And mastering this perspective, this deeper level of financial inquiry, that's what separates a good analyst from a great one. That is the skill that will truly set you apart.